Hello and welcome to the latest investment briefing from us here at Gemini Asset Management. 2022 was a difficult year for many different reasons, and not least for various asset markets. Bonds and equities both struggled, as well as many economies suffering with persistent and high inflation, as well as economic growth slowdowns. On top of this, there's been considerable geopolitical turmoil and plenty of political misjudgments that also impacted markets heavily. But the less said about trustonomics, the better. Having said all this, let's focus on a few of the main key themes of 2022 and look more specifically at what happened in the final quarter. The topics we'll be discussing are asset market performance, both bonds and equities, valuations, and the outlook for 2023. Let's start off with a touch of good news and consider the performance of equity and bond markets over the last quarter. The final quarter of 2022 was a positive one and gave some notable respite to some of the performance posted previously in the year. Chart 1, on screen now, shows the performance of the MSCI All Companies World Index, which is a global equity benchmark. And it also shows the Investment Association Global Mixed Bond Sector, which is an average of all the global bond funds that sit within that sector. The funds in the sector essentially invest in various different types of bonds from governments and businesses. As you can see, there was volatility in both equities and bonds, but they posted some positive returns over the final quarter of the year. Chart 2, on screen now, breaks this down in a little bit more granular detail. Within equity markets, emerging market shares were boosted by the Chinese relaxation of its zero-COVID policy, whilst the big winners were European and UK equities. Within bond markets, there was a distinct difference in the performance between government bonds and corporate bonds. Government bonds fell due to the market disappointment that the major central banks reiterated their plans to continue to tighten monetary policy. They did this by further increasing interest rates, even as inflation showed signs of slowing, and, in some cases, even peaking. Bonds issued by companies, broken down into corporate bonds and high-yield bonds, also advanced during the quarter, due to greater positive sentiment from the asset class, and especially so in relative terms, as investors focused on the idea of a potential impending recession in 2023. But more on this later. Relative attractiveness of different asset classes is important, as it helps us to gauge how to weight our allocations in the portfolio for a given risk profile. This relative attractiveness also applies to sub-asset classes too. So, equities can be broken down into sub-asset classes, maybe by region, such as US equities or UK equities, or by industry sector. And bonds can be broken down too into sub-asset classes, such as government bonds or corporate bonds. Some of the things that inform our ideas on what makes an asset class or sub-asset class relatively attractive compared to others are valuations and different variations of them. Looking at chart 3 on screen now, we can see the relative valuations of different equity regions. The valuation metric used here is the forward PE ratio. Simply, it's the current price of the equities in a given region divided by the earnings that the consensus of investment analysts are expecting these equities to generate over the next 12 months. This gives us some sort of context for equity markets, and it helps investors gauge whether or not they're buying expensive equities or cheap equities. The higher the forward PE ratio, the higher the price the investor is paying for the amount of earnings that the equity is expected to generate. It's important to note that a higher valuation doesn't necessarily mean the equity won't perform well over the next 12 months, but the valuation can act as a useful guide over the longer time period. Chart 3 shows various grey bars. These grey bars illustrate the range of forward PE valuations that were achieved in each equity region since 1990. You can see that the most expensive the UK equity market became on a forward PE valuation metric at least was roughly 25 times, and the cheapest it's been since 1990 was around 7.5 times. The green horizontal bar shows the average forward PE ratio in each of the equity regions since 1990. And this allows us to gauge if the price we'd be paying today would be cheap or expensive relative to the average prices paid over the same time period. The blue diamond shows the current forward PE valuation for a given equity region. If the blue diamond's below the green horizontal line, then it can be judged that, at least on a forward PE valuation metric, the equities are relatively cheap compared to their historical range and the average since 1990. As we can see here in chart 3, equities are typically looking relatively cheap, as the blue diamonds are mostly below the green lines. Of course, this doesn't mean that their prices can't fall and become even cheaper, but the fact that equities are relatively cheap is an interesting one, and it brings us to our last topic, the outlook for 2023. In 2023, many institutions expect recessions in developed economies. Unfortunately, recessions are just an unavoidable part of the economic life cycle, and they're a risk that must be managed. They can range from the severe recessions that we experienced during the Great Financial Crisis of 2008 to more mild recessions, which have had less of a negative impact on economies and businesses. Typically, in recessions, equities tend to fall beforehand, and safe haven assets tend to do relatively well in comparison. And this is one explanation for why investors may not be willing to pay more for equities at the moment. The relative attractiveness of equities, even though they're relatively cheap compared to the valuations over the last 32 years, has diminished. And there's other asset classes which investors are expecting to potentially fare better in the environment that we presently face. I must stress though, by no means is any of this a given, and there are many different factors that can change both the outlook for economies and different asset classes. It would be a dangerous game to essentially be putting all of your chips on red or on black, recession or no recession. And it leads us to our final point, which is diversification. Diversification is often talked about in the financial world, but at times of high uncertainty such as now, diversification can be an extremely useful tool. It enables investors to essentially spread their risks and hedge their bets to ensure that they're not making binary decisions. If, say, there were a rally in global equities, but an investor had put all of their funds in bonds expecting a recession, then the relative returns could potentially be quite poor. Here at General Asset Management, we'll continue to follow our established processes of effective diversification for a given risk profile and to ensure that we're not taking binary bets on any one outcome, especially at a time when uncertainty is so high. That's all from us here today. Thank you very much for watching.